Okay, great stuff. Let's do TYU2. I saw this and I thought this was, I mean, if you get this kind of thing, this is good practice because once you do TYU1, the whole thing starts to flow. You're like, okay, I sort of know what's going on here. So you have Paris and London. I think it's quite cheeky that they're making Paris the parent, but I won't say much. Anyway, here we are. So I'm just going to, well, work through the workings and then we'll go to the answer and see the connection. So Paris paid 1.5 million for 80% of London. So they control London, so that's fine. We'll write there. We'll do here, working one. Oops, sorry, I have some old material there. Let's erase that. Let's just get rid of that. Yeah, okay. So Paris controls London, 80%. Okay, we know that. You can call that working one if you like. Okay, let's see what happens next. It says goodwill impairment 1st of Jan. So they've owned them for a long time. 1st of Jan amounted to 152. So this is the beginning of the year. So this is all the pre-impairment, not the one for. I'm only interested, right, of course, in the impairment for this year. Remember, I'm only preparing the statement of profit or loss. If I'm preparing the statement of financial position, yes, then I want to include all the impairments up to date. But this is just the one I'm interested in. So 40,000. So definitely, I know that I need to deduct. It says impairment should be included within admin expenses. So I'm just going to come up here right now and admin expenses, and I'm going to add on 40 as I add all these across, right? So if you like, you want to add that on. But at the same time, I know that when I come to look at the non-controlling interest, I might as well do it now. So I know that the non-controlling interest, the parent, so that's 40,000. Parent owns 80%, and that's 32,000. Non-controlling interest owns 8,000, right? Because 20,000. So when I come to look at what profit when I'm looking at the profit for the non-controlling interest, I must remember to deduct 8,000 from the process, so to speak, right? From the non-controlling interest's profit. That's important. That's the important thing. Right. Okay. Kind of like in a working two. So I've just got that to the side. I've got that there. The other thing here is that that's it, and that's it. Fine. Great. I thought this was quite straight. They made sales of selling price of 1,600,000. I'm not forgetting it again. You have to derecognize that straight away. 600 out of there. 600 out of there. Right? Because this transaction should not have happened. That's the first thing. And then, of course, there's a question of a perp. Not all the goods have been sold, but they actually give us the perp. It says the profit element in London's closing is 30. If you like. So Paris made these sales. So the parent made the sales. So I have to deduct, or when I say deduct, I literally have to add on 30 to the cost of sales, because that's the relationship with me bringing down inventory. Cost of sales are going up by 30. And that's what's happening there. Then that was that. Then it says additional depreciation for the current year amounts to 10 grand. All of that should be charged to cost of sales. So if you like, I have my additional depreciation as a result of revaluing London, right? 10 grand. So when we come to look at the subsidiary, we need to think about that 10 grand again. That's important because that's working two, isn't it? Remember, that's working two. And that's an adjustment we need to put through. And then London paid an interim dividend on all its shares. That's 100% of its shares of 200,000. Parent owns 80%, so you would have received 80% of 200,000, which is why you receive. So 80% of 200,000. That's why you received 160. That needs to go. We cannot recognize any inter dividends at all. And you use the non-controlling interest. Okay, great. So that's me. So I just need to write all this out. This plus this minus this. This plus this, of course, minus the 600, plus the 30, plus the 10. 40 plus 8. Just add all this through and get rid of this. And you've done the top bit. And the only bit we have then left is to look at how we split whatever that. When I say split, how we assign profit to the non-controlling interest. So again, I'm going to treat this from a working 2-point perspective. I've done this and I get 400. That's what's happened during the year. So they would have had to suffer that additional depreciation, if you like, because it tells us that in the year you had additional depreciation of 10,000, and I think that's what it was. There was no perp. You didn't sell it. Paris made the sale, so the retained earnings is in the parent. That's fine. So it'll work its way out there. So we have the further impairment, which again I will assign. So I'll wait for that. So I have that depreciation and the fair value. This was a fair value movement. Where is it? There was no fair value movement. There's no, yes, just the additional fair value movement. This is from the past, but there's no actual fair value movement in this year. So that's kind of the point. I just want to make sure I've covered everything. Yes, I think I have covered everything. So technically, I have 390. I like doing it in 2 steps so you can see what's going on. So the non-controlling interest will have 20% of this. I'm not finished yet. 20% of 390. And that's 78,000. But we'll also need to take off its own loss due to the impairment, which remember we calculated earlier on, somewhere here, of 8,000. So I also need to take off 8,000 here as well, and therefore it sits comfortably at 70,000. I mean, I could have just said, of course, I could have said 400 minus 10 minus 40, and then taken off and then done 20%, right? I could have done all of this together as a whole. It doesn't really matter. But this is from a mathy point of view. Right, sorry, forgive me. I was interrupted by a phone call for my daughter's class. So it's like I had to deal with that quickly. So to a certain extent, I'm not almost slightly lost as to where I stopped, but let me just reconcile where I am with this. So I believe, yes. So here I have this, and let me just go back to my page. This is my page, right? So let's just walk through this and compare it to the answers. So I have 3,200 plus 2,500 minus 600. Let's check the answers. You have it there, 3,200 plus 2,560 minus 600. Then let's look at the cost of sales. Remember, I had the 220 plus this minus the 600 plus 30 plus 10. When I say minus 600, basically this is, if I was just, let me take off those brackets, I'd have 1480. I'm increasing my cost of sales, well, minus 600. I'm increasing my cost of sales, and I'm adding on my I think, what was it? There was the 10 was to do with the 10,000 was to do with here we are, the additional fair value depreciation. So coming here, you can see there it is. This minus the 600 plus 30, which is the pub, plus the 10. Then distribution, investment income. You see they don't allow it. That's the distribution costs there. The administrative costs, we put the 40 in there. We did that as well. Where are we? We added the 40 on to that. We got rid of that. And then we're done. Like I said, the issue that is what is important, you can see we calculated and we got our 70 grand. See, and I did it in 2 stages. I still think it's better to do it this way. Get your 400, take off the 10. you've got your 390, then take 20, so that was 20% of this, and then I took off the goodwill, its own goodwill impairment bit, and that takes me down to 70. And let's look at how they've treated theirs. They've got the same 70. Let's go to working 2. And they've done it as one big whole, like what I was saying from a mathy point of view. 400 minus 40 minus 10, which is what I was coming to talk about here. 400 minus 40 minus 10, which is 350 times that, and that's still 70,000. So both methods work, and both methods are perfect. Okay, awesome, great stuff. And that is TYU2. I will see you in TYU3. I think that might be next, or doesn't really matter. Whatever's next, I'll see you there. Okay.